Nischal Maheshwari, the CEO, Institutional Equities and Advisory at Centrum Broking, joins us now. Nischal, good morning and thanks for joining in. I'm sure you heard, our colleague Abhishek very helpfully putting out all the details of IRDA. And this is in a space which is growing, right? The renewable energy space. It's also the first PSU listing after LIC. Would you be interested in this one? Or would that be a recommendation to viewers?
Morning, Sonia, though I have not looked at it personally. But what Abhishek says, basically, it makes a lot of sense actually to subscribe to this issue. You're saying a 2% ROA with one-time book. I think if the leverage would be around 5-6 times, so easily you will be doing an ROE of around 14-15%. So I think that makes it interesting. The opportunity size for the renewable energy is big. The only thing remains to be what percentage is the government selling and whether there's going to be overhang, like what we saw in case of LIC. So that could be the only negative I see. Otherwise, I think it makes a lot of sense to subscribe to this issue.
What about the risk of asset quality, Nischal? Because these are long gestation periods, long gestation projects as well, and we've just seen the initial thrust on green energy and renewable. Is there a risk of asset quality? I believe the gross NPAs, the recent ones which have been reported, is about 4.5%. So right now, it's moderate, the gross NPAs. But would that be a risk for you?
So historically, we have seen basically in case of power plants, basically the risk of NPA, especially on the non-renewable side, has been high. We've seen plants actually going under. We have seen a lot of coal-based plants which have been closed. So I agree with you. Basically, I think that may be an issue. But here, the only good point is basically that they are not dependent on any coal price or anything. So it's sort of a renewable. So once you are set up, I think except for maintenance, there's not much of a cost. So that way, the NPA may not be very high. As I had said earlier, basically, I have not studied it, but I'm just telling you on the face of it, basically, that looks interesting to me at the point.
Okay, all right. Nischal, I wonder your view on Tata Steel and Coal India. Jefferies, they have come out with a note and they say they prefer Coal India in comparison to Tata Steel. And we highlighted that note last week itself, that Coal India is one of their top picks in the India mining and mineral space. But on Tata Steel, they have a buy rating out there, target price of around 145 rupees. So they've cut their EPS as well as the EBITDA estimates for the next, for the next few years because of the lower profitability in Europe. But they find the valuations at around 6.6 times its forward earnings, fairly in line with the long-term averages. Even they look at the price to book as well as the ROEs that it's delivering, taking that into account as well. They're seeing valuations in line. Now, what are they focusing on? They're saying, yes, China's economic data has been weak, and because of that, commodity prices have been weak. But now they're focusing on the Asian spreads. And the spreads out there have come in at the lowest levels you've seen in a decade. It's nearly the lowest levels you've seen since 2010. And two reasons for that. One is that steel prices have corrected from around $670 to around $540. And coking coal costs have gone up by close to around 40% in the last 6 months or so. And because of that, nearly 16% of the steel mills, well, they're only profitable in China as of October. So when lower amount of steel mills make profitability, that's the first sign that maybe spreads have bottomed out and things will look up from here. And they believe there's an upside risk right now. On Tata Steel India, they're saying that margins will improve in Q3, but there is a risk to Q4. Because in Q3, you have price increases that have come about and you'll get the benefit of lower coking coal costs. But in Q4, coking coal costs have gone up, so now we'll have to see further steel price hikes. And Tata Steel Europe, they're saying the losses should narrow from the Q4 onwards. And the Netherlands realigning of the blast furnace, well, that's almost behind them now. And that's why profitability will improve for Tata Steel Europe. So put all this together, the big call for them is that the spreads in China could likely be bottoming out and things could look up from here on. Nischal, what's your argument? Tata Steel, the last quarter's numbers were disappointing, but actually the stock hasn't corrected on those numbers. So clearly there is hope that China unlocks and it supports steel prices. Your take?
So I have not gone through the Jefferies report, but I think you put it very well here. But our call also is positive on Tata Steel, and the reasons are different totally, basically. Our call is more of a macro call, basically, and we continue, and we have now started believing that commodity is sort of on a bottoming cycle now. So I think there are a couple of pointers out there. You are seeing very clearly signs of interest rate peaking out across the world. You're seeing signs of relationships thawing between US and China. You're seeing signs that China is now once again stimulating its economy. These are all signs basically that the Chinese economy is going to do better as we go ahead. The world is going to start doing better, especially the US and Europe, as the interest rate starts getting cut in the next couple of quarters. So I think those are the things basically which we are looking for, and we believe basically not only metals, but I think even chemicals, we believe basically is in sort of a bottoming cycle. So commodities across the world seem to be in a bottoming cycle basically for this quarter, and we are positive on commodities now.
Okay, positive on commodities, got it. How are you feeling about IT now, Nischal? There are two views in the market, right? One, that IT stocks will move up because bond yields have cooled off, there's not so much a recession anymore. But the other is also that, you know, the worst of the slowdown, the worst of the, discretionary spending cut down, client spending cut down is not over just yet. So the ask rate is still very high. Which side of the fence are you on?
Very clearly on the buying side, we have been positive for the last 1 quarter now. So my view has always remained saying that I think the market is overestimating the higher for longer, and interest rates are going to get cut ahead of what the markets are expecting. And that's a view we continue to hold, and that's why we have gone positive on commodities now. We have been positive on IT, and we continue to be overweight on IT.